In this video, we are going to talk about the financial statements. It's a very important part of investing, is just understanding high level what is a set of financial statements, what to look out for, and how do I look at these numbers. You never need to know how to calculate the numbers. That's what the accountants get paid for. You need a few numbers out of the set of financial statements to make an informed investment decision. So the first thing that we need to do is we need to know, where do we find the financial statements? Now, for South African companies, the financial statements are often a part of the integrated annual report. That is a booklet that companies issue on an annual basis. The integrated report, the financial statements could be a part of it, or a company could issue a separate set of financial statements. And all of this is on the investor relations section of any company's website. For US companies, they look a little bit different. We call it the 10K and the 10Q. Don't let the numbers scare you. K means annual, Q means quarterly. So the 10K is the annual report, the 10Q is the quarterly report. So the financial statements are a part of those two. Now, what does a set of financial statements look like? You will find three main statements for any set of financial statements. The first statement that you get is the income statement. The second one is the balance sheet, and the last one is the cash flow statement. And these together make up a set of financial statements. Now let's look at the income statement first. All three of them have three sections. Very easy. The income statement has revenue, which is the sales of the company. It has all the costs, and it tells you if a company made a profit or a loss. Okay, so all the expenses, all the income, profit or loss. Let's move to the balance sheet. A balance sheet also has three sections. Balance sheet has assets, it has liabilities, and it has equity. So how do we read a balance sheet? Assets, must. How did you buy the assets? You either bought the assets with borrowed money, which is liabilities, or you bought the assets with the shareholders' money. So the money that belongs to shareholders is known as equity. Last statement, cash is king. Cash flow statement. A cash flow statement also has three sections. Operating activities, that's the money that the business makes, the company itself. So the operations of the business, the buying and the selling of cars, the making of bread and the selling of the bread, etc. So all the business activities. Then we get investing activities. Investing, it's just what it says, it's investment. So if the company invests in property, plant, and equipment, or they sell, some of their assets, that's all going to sit in investing activities, because that's not the normal part of their business. If they have a piece of equipment that they're selling, and they are not in the business of selling equipment, they're in the business of making bread, then that's an investing activity. And then the last is financing activities. Financing activities is actually so simple. It's any transactions that happens, cash transactions that happens between the company itself and the investors. Who are the investors? The investors are either the banks or the shareholders. So if a company pays out dividends, you are going to find it in the investing activities. If a company repays their debt, you are going to find it in the financing activities. Or if they make more debt, then you will be able to see it in the financing activities. Now let's break down each of these three statements. An income statement. The first thing that you need to know is an income statement is over a period of time. What does that mean? It means you look at an income statement for a certain period. So it can be an income statement for 3 months, for 6 months, for 9 months, for a full year. It's over a period of time. Now, a little bit more detail about an income statement. It is, you have to know, it always starts with revenue. A company exists to make sales. Okay, then you deduct the cost of sales. The cost of sales is the cost of making the product. If you are making bread, all the ingredients that you buy, that is the cost. Okay, then if you deduct the cost of sales from the revenue, you get to the gross profit. After the gross, so that's your gross profit. Whenever somebody says gross profit margin, they have taken the gross profit and they've divided it by the revenue just to give you a percentage. If the bread ingredients cost 70 Rand, you sell it for 100 Rand, your profit is 30, then they say the GP margin is 30%. All they did was they took the 30 and divided it by the 100. It's as simple as that. The next item that you see under gross profit, all the expenses that a company has. So you will find things like sales and marketing. You will find if a company has interest that they need to pay, if a company has tax that they need to pay, if they have, staff cost, all of that will be under the expenses and tax. And then you see if a company made profits or losses. Now let's look at an income statement. Tesla, because everybody knows Tesla. Let's start with Tesla's income statement. What are we looking for? We're looking for the revenue. Here we can see Tesla increased revenue from 31 billion to 54 billion, more or less. Then we look at the cost, the total cost of revenue. So how much does it take Elon to make those cars? 24 million last year, 40 million this year. Then we get to the gross profit. Now you know what the gross profit is. That's for all the fancy expenses that a company has to incur. So here you can see research and development, marketing, all of the other costs. Okay, then you will get to the net profit. Now, companies that are growing, it's very important to know this. Companies that are growing spend excessive amounts on research and development because they're going into the unknown, and they spend a lot of money on sales and marketing. So if they are growing, in order to grow your revenue, you have to spend on these two items. But also Tesla was very new. Now it's becoming more of a household name, so that they're not going to have to spend into perpetuity on a revenue. So that is how you read an income statement. Let's go over to the balance sheet. A balance sheet is at a point in time. It is a snapshot. It's your assets and your liabilities and your equity at a point in time. Many people leave accounting because of this equation. As soon as they hear assets equals liabilities plus equity, they are done with accounting because they don't know what it means. It is very simple. I told you that only two types of people put money into companies. It's either the shareholders or the banks. If you have assets of 100 million, the banks put in 50, the shareholders put in 50. This is why a balance sheet must always balance, because if the shareholders put in 50, the banks put in 50, and there's only 90 in assets, what happened to the other 10 million Rand or $10 million? Okay, so that is why we say assets must equal the money that the banks put in plus the money that the shareholders put in any combination. Now let's talk about the sections on a balance sheet, and this can drive people crazy, but it's really simple. Short term, STLT, very long term, very simple abbreviations in accounting. Current assets are short term. Those are assets that you can sell within the next 12 months. Things like cash, short term investments. If you have inventory, debtors that needs to repay you in the next 12 months, that is current, short term. Non-current, exactly the opposite. Anything that is going to benefit the company over the long term. If a company has a factory, they're not going to use the factory up in 12 months. It's probably over a life of 90 years, 99 years. Okay, that's long-term assets. Flip side, on the liability side and the equity side of the balance sheet, short term, anything that the company must repay in 12 months. So creditors, they have to pay their creditors. Creditors, people who gave them short-term funding. They bought some equipment and now they have to pay for it in the next 12 months. Long-term, after 12 months. So if Elon borrowed 10 billion from the bank and he's going to repay it over 10 years, anything that he's going to pay in the first 12 months is short-term, that is due to the banks. Anything from 2 years to 10 years, long-term liabilities. Okay, long-term liabilities often come with interest. That's the very important thing. Equity. Equity is the money that the shareholders put into the business. It's as simple as that. Any accumulated profits or losses, or any profits that the company did not pay out in the form of dividends, those belong to the shareholders of the business, and it accumulates into equity. So the hard cash that we put in, plus any accumulated profits and losses that's sitting in there. Now let's look at a balance sheet. We're sticking with Tesla. On the balance sheet, current assets, non-current assets. So there you can see all your short-term assets, your long-term assets, things that they're going to use after 12 months. Short-term liabilities. So there you can see your creditors, any deferred revenues, smaller items, but it's mostly creditors in there. Then you have your long-term liabilities. So anything that must be repaid after 12 months. And then we have equity, 30 billion that's sitting in there, belongs to the shareholders of Tesla. Now, what do I care about on a balance sheet when I'm doing research? I care about how much cash a company has. Cash is king. So here we can see the company has 17 billion in cash. I compare that number to how much debt they have. Tesla has 5 billion in debt. What does this mean? Elon can wake up the next day and decide to pay back all the debt because he has 17 billion in cash and only 5 billion in debt. If that's the situation, I'm done with the balance sheet. Okay. If it was the other way around, then I check, okay, there's 5 billion, let's say there's 17 billion in debt. How much did the shareholders put in? The shareholders put in 30. I do not invest in companies where the banks have put in more money than me and my fellow shareholders. That means the bank owns this business, not the shareholders. So it's as simple as that. Cash is more than the debt, you're done. If the debt is more than the cash, check how much money did the shareholders put in versus how much money the banks put in. Then you will see who your company belongs to. Cash flow statement. Cash flow statement, I'm here for 2 numbers and 2 numbers only, but also know it's over a period of time. So this is the cash. We're going to talk about the cash from operating activities, which is, as I said, the money that the business made in itself. So any buying and selling, etc. The investing activities, we'll quickly look at that. That's anything that the company has invested in property, plant and equipment, etc. And then financing activities, as I said, that is between any cash transactions between the company and their shareholders and investors. Now let's look at an example to make it very practical. Here's the Tesla cash flow statement. A lot of numbers. You don't need all of these numbers. So don't run away from financial statements because there are a lot of numbers. Already on the income statement, you need 3 numbers. Balance sheet, you need 3 numbers. Now I'm going to show you on the cash flow statement, you only need 2 numbers. Okay, so let's see operating activities, investing activities, and financing activities. Now, what are the numbers that I care about on a cash flow statement? This is exactly the same thing. It's the free cash flow. And this confuses people sometimes, but it really is very, very simple. So if a company's operations makes money, okay, that is the biggest thing that you want, is the business must make cash. So more cash must come into the business than goes out of the business. Now let's look at Tesla. Tesla, the business itself makes 11 billion in cash. Okay, so if you look at an income statement, there are a lot of items. All these items that's here, they are non-cash items. Items like depreciation, stock compensation, net profits or losses from selling assets. Those are fake numbers. They are accounting numbers. So to get from the profit or loss, you have to add back and deduct all those funny entries. And then you get to the cash from operations. So now we can see Tesla makes, the business itself makes 11 billion in cash. But a company, and this is very important, you can't stop at that line. A company cannot continue operating if they do not reinvest in plant and equipment. Why? Plant and equipment has a limited useful life. So if a plant, let's say we buy a piece, Tesla buys a machine, and the machine costs $2 billion. They use this machine. If they are not replacing the parts and replacing everything that is needed, a business that does not reinvest in their plant and equipment cannot continue to operate. And that is why we call, if you take that number and you add that number, a positive and a negative, if those two are positive, it means this business is free cash flow positive. The money that is left after those two numbers is available to the investors of the company. Then we can decide, okay, now we can repay the debt. We can pay some dividends. That is free cash flow. You have to understand this concept, because a lot of people will say, oh, the operations are making money. And then they forget we still need to keep on replacing the plant and equipment so that in years to come, we can continue making money. That is responsible management. So our next lesson is going to be on ratios that matter from financial statements. A lot of people struggle with ratios. There are 10 ratios I'm going to take you guys through in the next lesson. So stick around. And thanks for listening to me talk about my favorite topic, financial statements.